So what I'd like to do now is introduce you to Micheal Savy. Micheal Savy is our financial planner. Michael's role in the business is to also help people create wealth. He does it through superannuation, managed funds, and anything that's a licensed investment product. Talking about property is technically not a licensed investment product. That's why I'm a qualified property investment advisor. So Michael's going to be talking about personal defences in terms of we're going to put this strategy in place. We've got to do everything we can to protect it, to ensure that we've got that cash flow coming through. So welcome, Micheal. Here's our planning display. So give you a moment to read through that.
Can everyone hear me all right?
Yes.
Good. Hopefully everyone's a speed reader and got through that. Now, that was certainly a tough act to follow, and I apologise in advance because I'm not exactly as lively as Ben. So, and given the subject matter, if anyone falls asleep, I won't blame you. Insurance, as you can see there, it is a part of the overall wealth management strategy. But it's one of those things where it doesn't really pop up to the forefront of our mind unless we realise that there's an asset at stake, and more importantly, there's a potential to lose it. So that's why when Ben asked me to come up and do this presentation, I was quite excited to have this opportunity, because unfortunately only 5% of us have adequate insurance. So I was quite glad to see the hands going up today for life, TB and income protection, although I did see only a few hands go up for some trauma cover. So hopefully I can go through some of that with you. Now, so I will be going over Jason and Amy's scenario again, just to point out, I guess, a different perspective. So far we've seen different projections where they buy one property, 2 properties, 3 properties, pay out their debts. So we've seen, I guess, a positive scenario going from 40,000 living costs to 200,000. But one scenario that they haven't looked at is, what if something happened to one of them? What would happen if the income disappeared? And that's why, as financial planners, we are, or I am certainly, very passionate about this subject. And I guess you're probably wondering, how can you possibly be passionate about insurance? I mean, it's insurance, so it's quite boring. But the reality is, I've been in this business for 10 years, and over that time I have had instances where I've had to sit there with clients, often a lot of the times for the first time, and they would tell me that they've just been diagnosed with severe illness, critical illness, and in some cases terminal illness. So, having seen that, I've seen the difference. I guess more than anything, it's the relief in the face of the people that have insurance and enough to cover their expenses to do the things that they want to do, versus those who come in to see me to see if we can get money out of the super, find cash somewhere else. So that's really what insurance is about. So just to restate some of the key things with the earlier scenario, Jason on a salary of 82, Amy 68. They're planning to retire in 32 years' time. Over that period, gross income, so this is just the earnings from their salary, not the investment income that we just showed you that they would generate if they invested it. So what would happen to that income or their scenario? Remember that 7.5 million there? We showed you the Westpac study and all the expenses that are going to come out. So school fees, mortgages, that's all going to come out of that. And whatever's left over, that's for our retirement. So I don't think Popey actually listed his occupation, so for the purpose of this scenario, I'm going to assume that he's a builder. So he's earning a nice $82,000 as a builder, and let's pretend that he's, as a 35-year-old, has been diagnosed with Parkinson's. Now you're probably thinking he's a bit young, but remember Michael J. Fox was 30 when he got diagnosed. But unlike Michael J. Fox, he needs his hands as a builder. So Jason's still going to be around with us, but that $82,000 is not going to be there anymore. In fact, it's only $3.4 million. On a weekly basis, that's $2,500 in income that their family won't have anymore. So, whilst I'm running this scenario through Jason and Amy, think about your situation. What would you have to give up and your plans if $2,500 a week wasn't coming in anymore? But we have, in the scenario, I'm pretty sure I saw there $2,000 in insurance premiums there, so they do have some cover. But the funny thing is, more than likely, they've got car insurance. So I pretended that they got a $42,000 brand new Holden Commodore. According to the RACV, that's $1,000 premium a year. Out of interest, I assume that maybe they don't have a brand new car. $13,000 Holden, still $1,200. Don't ask me about the price difference. 99, $1,000 as well. So you can see that you've got a car that I'm pretty sure most of us have got insurance on. That's depreciating in value, and you've got a $7.5 million coming in over the next 32 years. But we rarely ever think about insuring that. Maybe except this crowd. But that's not uncommon. So these are the numbers now. I do recall seeing a fair few put your hands up for life insurance. So just keep in mind these numbers were put in place before Super had to give you some life insurance as well. So we can see that 87% of Australians are prepared to insure their motor vehicles, home and contents. 72% of us insure the home, the building itself. But when it comes to ourselves, 17% of us insure for life, so obviously it's a little bit higher in this room. 9% of us insure against TPD, so that's against total and permanent disability. Sorry, that's income protection, I should say. 5% insure for TPD. But only 2 of us have the presence of mind to insure against heart attacks, strokes, and cancers through some trauma cover. So why is insurance important, or why should it be important? Because it can help us pay off our debts. It can certainly pay you an income now and into retirement. Pay those large medical expenses, rehabilitation costs, some recovery time. But most importantly to me as an advisor, it certainly can help you maintain your lifestyle that you're accustomed to. So hopefully by now this question's a little rhetorical. What is the greatest asset? You, or your health, because it's your income that we're really insuring. Whilst we talk about life insurance, you're thinking about life, you, your health, it's really your income, your cash flow, which is the important part about this whole wealth creation process. Without it, we don't have much. If anyone has had the pleasure of being in the meetings with me one-on-one, and in the future, you'll probably hear me say, insurance is a numbers game. So let's look at some of these numbers. But before we do, the scary ones, at least anyway, the Powerball. If you're like me, my mates and I put $10 a week each for the Powerball, and if we ever win, you'll see plenty of hot dog stands around Melbourne. So 1 in 54 million is the probability of us winning. So you'll have to wait a little longer. But when it comes to us, these are the numbers that are really close to home that may affect us. 1 in 3 men have a chance of suffering critical illness before age 65. And when they do, it's usually for greater than 3 months. Actually, the age 65 point there is also quite important these days, because, as some of you may know, the government has pushed the retirement or pension age to age 67. So the reality is, 1 in 3 men will have this event happen within their working life.
Sorry,
for women, that's 1 in 4. So the question I pose here is, if you were ill, couldn't go to work, how long could you guys last with your cash reserves and your assets in place now? So some other truths, or some other numbers really. 1 in 3 men and 1 in 4 women will be diagnosed with cancer before age 65. 88,000 new cases diagnosed each year. The treatments and whatnot are improving the survival rates. But still 36,000 people die each year from it. And melanoma is still 1,000 per year. Breast cancer is still the largest component for women. 1 in 9 will be diagnosed before age 85. 36 women in Australia are diagnosed daily. Now I'm running through these numbers and it can be a little bit boring, but there is a purpose. I'll explain why I'm discussing these ones more so a little bit later. This is really the scary one for me. 9 out of 10 women had no family history. And those numbers grow each year. Strokes, this is actually the second largest killer in Australia. 60% of people who have strokes were over 65, 18 were under 55, and the scary bit for me, I'm 31, 5% had it under age 45. So there you go, still the second biggest killer. And now we come to number 1, heart disease. For a 40-year-old, that's 1 in 2 men and 1 in 3 women will likely develop coronary heart disease. Coronary heart disease, unlike the other ones, there's a lot of lifestyle factors that really affect that. So smoking, drinking, fatty foods, Maccas, all those things. So that's why it's still the number 1 killer in Australia. 355,000 Australians currently have it now. So I guess so the question is, how do we stop these illnesses? How can we stop it from happening? I'm not a doctor, so I can't really say, but we can certainly try and help ourselves by living a healthy lifestyle, exercising and all those things. We know the risks, but for us as an advisor and for you guys as investors who are embarking on this journey, the wealth creation journey, is what do we do if it happens and how do we minimise the impact? And for those of you who think that you're bulletproof and you'll be right if something happens, well, this is actually a real life case for one of my clients who happens to also be one of my mates. So I was a little hesitant to actually use the scenario, but I've changed their names, so hopefully you won't recognise the story. Tim and Rosie, in their mid-40s. They've got a mortgage on their property. Their oldest son has just finished private school in Adelaide and their daughter's still there. They were actually thinking about buying an investment property now that the oldest is gone. They've only got a couple of years left for the daughter. They might start this investment or wealth creation, start thinking about themselves. Now Tim, he's essentially, even though he's 40, he's pretty much a 20-year-old trapped in a 40-year-old. So every time I go back to visit, we're usually at the pub, having a few drinks, smokes, and Rosie, who's a nurse, she understands the risks of all those things, and every time she smells smoke on him, she'd give him an earful. So she was the healthy one in the family. She was the one that looked after, made sure everyone ate right. She was active. So you're thinking, what's the risk? If anything, Tim was the one that's high risk, but she had no family history of mental illness. But then all of a sudden her father passed away. And the politics at the hospital became too much for her, and she actually went into depression. So by the time I actually caught up with Tim and had a chat with him to discuss this, I didn't realise this had happened. Rosie was actually hospitalised, or in hospital, under treatment. But unfortunately, one of those things where, or circumstances where everything that could go wrong did go wrong. Tim's job, he was made redundant. 20 years in a store, and they were closing up thanks to the GFC. So all of a sudden, Tim's balancing the books, the mortgage is falling behind a little bit, some of the bills, spending time at the hospital with his wife, making sure the food's ready for the kids. That's an understatement. He was pretty stressed. So the reason why we caught up and why he rang me and wanted to chat was, as I said, he wanted to know, could he take his money out of his super? Kid money was only 46 at the time. Could he take his money out of super and pay for some of the loan repayments and some of the bills? Unfortunately, he couldn't. But thank God, as I was sifting through the paperwork, there was an insurance policy in there. He, as far as he knew, he had a life cover, and that was it. The advisor that put it in place all those years ago had disappeared, probably retired. So he didn't realise he had income protection. So we claimed that. I sent him the paperwork, we made the claims, he's paying the bills. But it's not having the cover there didn't get Rosie better faster, but it certainly relieved some of the stress for the family. So the good news is, a year and a bit later, Tim's back at work and Rosie's recovering at home, so she's out of hospital. So that's a reasonably good news story. But in terms of wealth creation, which is really the theme and why you're really here tonight, that plan for them to buy that investment property and start building their retirement, that's probably been put on hold. Because unfortunately they only had life and income protection. So why do I say only had life and income protection? Because there's 4 main types of insurance cover that you can get. With the exception of life, they're not mutually exclusive. They should be structured appropriately so you can maximise the benefits to make sure that you can maintain your goals and your wealth creation. For example, how do I pay my bills? If that's the question. Credit cards, home loans, electricity, income protection. They'll pay you 75% of your income on a monthly basis if you can't go to work due to illness or injury. How do I get rid of my mortgage? Or if we need a carer or a babysitter, nannies, all those things. Life and TPD. Trauma. Again, like I said, I've noticed not too many people had their hands up for trauma. Trauma is one of those things where, unlike the others, it's quite predetermined. They'll only cover you for certain specified events. A good policy will cover you for at least 40 or 50 illnesses. I've seen bad ones that will cover you for only 5. The significance of me bringing up the cancer, stroke, and heart attacks, all the insurance companies, that comprises 80% of most of their trauma payouts. That's what we use that for, medical bills, recovery time, any rehabilitation equipment that we need, things that private health won't cover. So the importance of insurance, hopefully you sort of have an idea how and why. Because we know that when we realise there's an asset that we can easily value, an asset that's material that we can touch and we can feel, like our house and investment properties, contents, boats, cars, it's easy for us to go out and understand that there can potentially be losses, so we'll insure that. But that's only half the picture. When you look in the mirror, think about the income that you're bringing into your family and how valuable you are to your family. The reality is we're insuring your income, your wealth that will come from your income. And that's why insurance, I should say, is an important component of all wealth creation strategies. And lastly, Jason and Amy, now I did say that we had some insurance for them. I actually ran some quotes for Popey when he put that together. I actually assumed that they had 820 in life cover and TPD cover, 110 in trauma, and both their incomes were 75% insured, so the maximum insured. So, I don't know your opinions on that, but having a look at that, whether or not that's adequate. Professionally looking at that, that's the bare minimum for me. Because again, like my mate, he had life cover, enough to cover his loans, his debts, but the income protection wasn't enough for him to put them in the track or the path that they had intended. And it's the same with this 820,000. It's enough to maintain their lifestyle, but not that wealth creation that they planned. The total cost of that was $3,500. But as you saw in the projections, we actually had it for $2,000, and that's because we structured that some of that through super. So we can always structure that. Now we'd like to go through the super structuring through super, but unfortunately that means we have to talk about superannuation rules, and that means we've probably got about another hour to go. So I'll probably say that for a next one. So this is really the halftime show between the two main acts. So
Not at all.
So with that, I'll leave that for leave it open to questions if you have any.
Any questions?
With trauma insurance, do you know what the percentage of payout is in relation to premiums collected?
Off the top, I'm not too familiar with the amount of premiums collected, but I know in 2009, total trauma payouts was $300 million collectively in Australia, or 322, somewhere abouts.
But you don't know approximately what the collections were?
No. I'll probably have to jump on them and have a look. Leave me your email, I can certainly let you know.
I suppose the question for everyone really is if you can wrap that up into your overall cash flow strategy, would you do it? Because if you're getting 75% of your income, would you have to sell one of those properties or potentially both? Maybe not. So you're going to be paid that for the rest of your life if you're diagnosed and you can't go back to work. So for the rest of, not for the rest of your life, up until retirement age, you're going to be paid that money. So technically, that buys you time in your investment strategy. So when I look at defence, that's what I'm looking at. I wrap that up into my cash flows, and then it's not something I look at in isolation. Because if you start looking at, that insurance policy comes through every week and it's $274 a month, you're thinking, God, that's expensive.
Sorry, just to correct that, the income protection will pay you up to the term that you select. So for those of you who are relying on your income protection in super, it's more than likely to have a term of 2 years, unless you remembered filling out a form to ask for more. So just keep that in mind.
So it's complex stuff, and that's why you should be getting advice around it. But I keep coming back to the point. If you can't generate the cash flow, put the defences in place that can. It's as simple as that. And that's why when you look at our sophisticated model, we have insurances as an asset. Because you don't want to ever claim on an insurance policy because it means something's wrong. But if you have to sell properties to get you through that time, you've just undone all that good work. So why do we want to undo all that good work? Yes, sir. Is income protection tax deductible? Is income protection tax deductible? Good question.
If you pay for it yourself out of your own cash flow, it's tax deductible because the proceeds will be taxable in your hands when you make a claim. If it's held within your superannuation fund, then no. Your superannuation fund gets to claim that deduction.
Any other questions? Okay.
Thanks a lot.
Thanks very much, Michael.